Morning everyone, welcome to this update for global markets for the 19th of April. This will be a reasonably short video update because not a lot changed during last week. Markets mainly in sideways consolidation mode, whether that be stocks, currencies and the bond market, and also to a degree commodities as well. So let's get into it and have a look at what happened last week. The S&P ended up down 1% for the week, and that was all on Friday night. Now, that large drop, most people seem to be blaming it on concerns about Greece leaving the euro and about what's happening in China with their weaker data. But Friday night was options expiry date, and I would like to bet that a lot of the sharp fall was related to the expiry of options. Anyway, it doesn't really matter what it is in the short term. As far as I'm concerned, the trend remains up, and some of the other indicators that I follow don't really support the fact that there's any kind of change in sentiment in the US market. Now, certainly the quarterly profit numbers are a little bit of a concern because the strength of the US dollar has certainly hindered the profits of some of the international companies. But it's not a particularly big deal, and that was pretty much all priced into the stocks anyway. Now, at 17 times earnings, the general market, so I'm really referring there to the S&P 500, it's not a bargain. It's not expensive, but it's not a bargain either. But there are still some stocks in high growth mode in the sectors that I'm focusing my attention on that still are a terrific bargain and offer a very appealing upside for the medium to longer term. And as I indicated earlier, what happened in the bond market and the VIX index suggests that there's no real change in trend. Considering the Dow was down nearly 300 points on Friday night, there was very little movement in the VIX index, which really supports my view that that was just due to some very specific one-off factors on the day. Now the Aussie market, our index ended down by 90 points, and again, most of that was on Friday. It's quite remarkable how often our market precedes a big fall or rise on the US market, and I think it's because some of the key players here, which are also international players, they know how the US traders are intending to go into the next session. And so quite often you'll see preemptive moves in the Australian market and also in other Asian markets. So 6,000 points is proving to be a tough barrier for the index to get through, and so it should, because there's really no value in the Australian market. The banks are looking very toppy to me, but it's a brave person that would call for a significant fall in the banks. They're overvalued, there's no question about that, but they're unlikely to fall very far because of the yields, and the yields are reasonably attractive in Australia, but they're even more attractive to overseas investors. And for that reason, I don't think our market's going to fall very far, and probably the banks won't either. Now, there are a few better entries in the Australian stocks, in the great growth stocks. We've got a small handful of really good growth stocks here. So a bit better value is coming into focus. But again, you still need to be really selective and really careful in the Australian market because there's just no value here at all. So let's have a look at a couple of the charts. This is the S&P 500 index on a monthly chart. So this is a big picture look at the market. This most recent major low occurred in March of 2009. So that's coming out of the GFC. And since then, it's been a very, very strong trend. And you can see that there's really no change in trend there at all. The market has been technically overvalued for quite a period of time, but it's not really showing any signs of coming back. Let's zero in a little bit more and look on the daily. So you can see, whilst it was a reasonably sharp move on Friday night, in the context of other moves that have gone on recently, it really isn't very much to get excited about, that's for sure. If we look at the VIX index, you can see there was a little bit of a spike up. We were down around 12 going into Friday's session. We spiked up to about 14.5, which is really no particular move at all. So that's why I'm not concerned about what went on Friday night. I don't see any change in sentiment or trend for the US market. Now, just for the record, here's the Australian index. As regular viewers would know, I don't place a lot of emphasis on the Australian ASX 200 index because it really just reflects what's going on with the banks and a couple of other major stocks like Telstra and the mining stocks. So that's just for the record, but you can see we've basically been in sideways mode here between about 57.50 and 6,000, and that's really been the case since early February, so pretty much most of this year. Commodity prices, gold was flat on the week again. That's the second week in a row, and there's still really no definitive move there in gold stocks either. And as I've been saying now for a couple of weeks, the only thing that's really going to change this scenario for gold is that either the US dollar needs to change trend and start to fall, or alternatively the financial system falling apart in some dimension needs to re-emerge, and it's hard to see either of those circumstances appearing at the moment. There's just no triggers to make that happen. Copper steady at 274, and the price again is the US dollar's going sideways. We'll have a look at that chart in a minute, and so most of the commodities are doing the same. Now the only exception, of course, was crude oil. A little bit firmer to $56, but I really suspect this is about some short covering in the market. There was a lot of major players who were short oil and short a lot of oil instruments, derivative instruments, and there was a feeling that maybe oil had hit bottom in the low 40s, and look, that may prove to be the case. But a lot of this sharp move in oil is, I believe, is short covering, and therefore has probably played itself out unless crude oil has found a base. Sitting right at key resistance, 55, 56 is a key resistance level, so we need to watch that. And many analysts are calling for a bottom in oil, but look, the fundamental supply and demand for oil at the moment, the world is still awash with oil, don't support that, and I don't believe enough, if any, production has been forced out of the market. Higher cost production has been forced out of the market for any length of time, particularly in America. They can, if the price goes back up again, they'll just switch that production back on again. So I don't expect that we're going to see oil start to go back into an uptrend just yet. So let's just take a look at those few charts. We'll start with the US dollar index because that certainly is driving stock markets and a lot of commodity markets as well. So you can see it's really been in this sideways range. It's been in an unbelievably strong trend that's gone on for almost a record-breaking length of time. But we're in this range between about 96.5 on the US dollar index and roughly 100. And that's been the case now since early March. So we're talking now about 5 or 6 weeks of consolidation. So nothing else much is moving while that's going on. Let's have a look at gold. This is gold on a weekly chart. So you can see we continue to hold. We're in this wedge pattern. We continue to hold towards the bottom of that wedge pattern. Whilst a lot of the fundamentals of supply and demand around physical gold would suggest that we could see the start of a new bull market. Technically, this is looking very shaky, and if I had to pick a direction, as much as it pains me to say this, I would have to go for gold breaking down and perhaps making a run towards $1,000. I'm not saying that will happen, but technically that's the way it looks. We've got a declining wedge pattern here. We've got lower highs all the way through. The market has been unable to establish a higher high on a medium-term view, and that's just the reality of where the gold market is at the moment. There's the spot copper chart. Also, it hasn't done very much. So just to wrap it up, again, nothing much has changed here. I see stocks moving higher over the year. I see this as an ideal environment for stocks at a big picture level. We've got virtually zero interest rates in much of the world. We've got extraordinary levels of stimulation, monetary stimulation by the central banks of Europe, Japan. There's also stimulation going on in China. So really, it's an ideal environment for stocks, for good stocks to move higher. I don't believe, though, this is a tide that's going to float all boats, but certainly the good stocks will not have an impediment to be able to move higher. April tends to be a stronger month. It's been a bit up and down so far, but tends to be a bit of a stronger month. And we may just see the main indices heading sideways from now until later on in the year, because May, June, July, August tend to be weaker months. And with US earnings certainly weaker, that may be where we see the main indices go. However, great stocks should continue to outperform, and for me, diversifying your activities outside Australia is just an absolute given. The US, certain sectors in the US remain extremely attractive, but it's not the only place to look, and as members of Specialist Share Education know, it's not the only place that we're currently trading and investing in. So that's the rundown for this week. Cheers.